What's up, guys? It's Rowan
and Terry
from Artist Smart TV, bringing you another episode of the HSC Economics Review. Now, in this episode, we're going to be diving deep into the current account. Now, at the moment, we have a current account surplus, but historically, that was not true. In fact, we've had a current account deficit averaging about minus 2.91% of GDP from 1959 to 2023 over that entire period. Now, in saying that, right, in recent years, since roughly mid-2019, we saw it flip from a current account deficit to a current account surplus. And so in this video, what we want to unpack is why did that occur, right? Why did we see a flip from a deficit to a surplus? What does that mean for the Australian economy? And in doing so, we're going to unpack a number of the trends in our current account, which is something that's going to be really key as part of the balance of payments that you'll be unpacking in topic 2 in the HSC Economics course. So maybe to kick things off, Terry, I suppose, what was going on in 2019 that caused us to go from a current account deficit to a current account surplus? And maybe before we even start that, it might be helpful just to quickly, what is the current account? Maybe let's just put that out there,
because it's going to be a very challenging topic that a lot of students run into as they start 2024, which is probably not the best topic to start the year on, but you just got to kind of stick through it, and hopefully, if you watch our video, you'll have a bit of help from us. So first and foremost, the current account measures the ins and outs in terms of income from Australia, and if you record a deficit, that means you are losing money to foreigners, whereas if you record a surplus, foreigners are actually giving money into Australia for those kind of short-term transactions. And so what happened, I think if we want to start with, we can't really start this story in 2019, because I think a lot of the events that kind of led to that were kind of bubbling in the background.
Probably even from as early as 2016, we start seeing things shift, definitely.
Yeah, so the big way that we can kind of split this up is, yes, we have deficits and we have surpluses, but there's I like to think of it as two main categories. You've got, first of all, the reason why we're in a deficit in the first place, which is the savings investment gap. Now, that's what we call a structural factor. And if you remember your understanding of economics, anything that's a structural factor, that's to do with the way that your economy is set up. And nothing that's really going to, no kind of short-term fluctuation is really going to be able to change that. You have to undergo some kind of structural change. Now, there is a bit of structural change that we'll get into in terms of, in terms of the financial investments coming in and out of Australia. Yeah. The big one, though, so the structural things are always going to be there. And that's usually going to make us in a deficit. That's why we were in a deficit for so long.
Right. We were known as a net capital importer, basically, right? Which meant that we had a shortage of domestic savings that was not able to fund the domestic demand for investment. And so as a result, we're having to go overseas and we're having to import that capital. And we're importing that capital through our capital and financial account, specifically the financial account, which is the pair to the current account, which is important to highlight, right? Because while we've talked about a current account deficit here, we're sort of highlighting that actually the cause of this thing structurally is coming from somewhere else, right?
Yeah, and I think what a lot of students tend to gravitate towards is this idea that, if one of those is in deficit, the other one must be in a surplus. But what they don't appreciate is the why. Now, let us know in the comments if you actually do want us to ever do a video about that at some point, or if we already have a video. We've done so many videos, kind of lose track of what we've done videos on, but I'm sure if we do wrong, we'll be able to link that in the comments for you. Because I think it's a lot of students, they take that for granted. They go, CAFRA's been in a surplus, therefore current account's going to be in a deficit. But why? The real top band students are going to be able to actually articulate why. So that's the structural side of things. But what's probably going to be the crux of this video is the cyclical things, and the cyclical things that have been going on in terms of the balance of trade, the balance of goods and services.
Yeah. Without a doubt. And I think that's exactly it. So I think what we're sort of highlighting here, just very, very quickly to recap, is we've had a current account deficit. The reason for it structurally has been because we've been importing capital to fund investment demand in Australia. But for some reason, by 2019, things have changed. So our current account is no longer in a deficit. And this is probably not due to any major structural change with the economy. So why? And so as Terry's highlighted, there have been some cyclical things that were going on. And I think one of the first things that really started to occur was that we started to see a very large trade surplus start to grow. Now, again, that didn't happen immediately in 2019.
It'd been growing for quite some time.
That's right. It'd been growing really, probably the tailwind started as early as 2016. Okay, and there were a couple of things that were happening there because we saw our trade balance start to move into a surplus in late 2016. And in fact, right, just to highlight, it actually has culminated in that trade balance reaching a record of 7% of nominal GDP by September quarter 2021. So something was going on here that was driving that. Yeah. Now, what were some of the drivers, Terry, that were causing our trade balance on the current account to become so overwhelmingly in surplus?
Yeah, I just want to, before we jump into that, because I think I just want to highlight something about 7% of GDP. Now, that probably doesn't sound like a lot to a lot of people, but what you've got to appreciate is that when we measure things in terms of GDP, that's the production of the entire country. So what Rowan is basically saying is that for the September quarter of 2021, we were earning an additional 7% just from foreign sources of income. Because remember, and I want to keep going back to this, is because we need to understand the current account really is that relationship between Australia and the rest of the world, which is why this is the topic Australia's place in the global economy. Mm-hmm. And so if you're earning an additional 7% on export income, that's huge.
It's big.
It's a lot of extra money coming in because, you think about what the size of GDP is usually about between 1.5 and 2 trillion. Mm. And so I can't do the math off the top of my head. Don't make me do it. But 7% of that is an enormous sum of money. So this doesn't happen overnight. Okay, and so that's why if we're going to look at one of the biggest drivers, to kind of go back to what the original question was, one of the biggest drivers of that was obviously, and you heard your teacher say this many times, the mining boom, the mining investment boom.
And it's interesting because a lot of the time I think when students think of like mining boom, right, they're going back to like 2012, right? They're thinking like, okay, great, like that, that was the peak of the mining boom. So what are we talking about here really, Terry, right? Because we're not really talking about that, right? I think we're talking about the legacy of that.
Yes.
What is it?
Yeah, so I think one thing which the textbooks don't do a good, I shouldn't say don't do a good enough, but maybe don't do as much of is separating the fact that the mining boom kind of happens in phases. And I like that you use the word legacy, because with a mining boom it's almost like you can think of it in a couple of stages. So first you're going to have a lot of investment pouring in. You've got a lot of companies who are very interested in extracting commodities from Australia. Okay, a lot of them are Australian companies, but they've got a lot of ownership overseas. So you've got overseas investors buying up shares. That's obviously going to be reflected in a CAFA credit, and that's what causes the surplus in the first place. But then on the other hand, once they don't just put the money in here. I think sometimes economics can get a little bit separated from reality. They don't just chuck the money in here. They actually go and use that money to purchase up capital, and they actually go out and start excavating. They start going in and digging and finding stuff. And then they go off and sell that.
Yeah, and so they're doing it for a return on their investment fundamentally, right? And so I think what Terry, you're highlighting, which I think is really important for students, and I think this sort of language I think can be really helpful when you're talking about the current account and the drivers in the trends here, particularly in essays, is to distinguish between the investment phase of the mining boom and the production phase of the mining boom, because that's really what we're talking about, right? It went from an investment phase in the 2011s, 2012s, 2013s. Took a couple of years. Obviously, there's a delay. A significant amount of investment needs to happen, and to build the capital infrastructure. And what you start seeing by about 2016, not only there's a couple of other variables at play, right? But one of the variables is that you start seeing the phase move into a production phase. And so what that starts to see occur is we start to see the relative price of exports also simultaneously rising at that time. Okay, which is sort of neat because what we start to see happen is terms of trade that grows significantly. So, to give you context, right, the terms of trade, now are roughly 50% higher than they were when they hit like a trough in 2016, right? So there's been this ongoing increase that occurred, right, during that time period. And a lot of that was reflected in increased prices, particularly, iron ore, but certainly LNG and coal prices as well. And so I think the result of that really is that, Australia is being able to sell, one of our core exports at better prices, fundamentally, right? Which is helping drive really strong export returns. Now, I want to pause for a moment, Terry, because I think this is a good opportunity to also look at how the trends that we've seen here, from 2016, in terms of moving our trade balance to the positive is not just a reflection of like a couple of years, but it's actually, if we zoom out, it's also a reflection of the broader changes that's been happening in the composition of our exports over the last 50 years, right? So I'd love to just only very briefly dive in and sort of say, well, what has changed, right, with the composition of our exports that makes our resource exports even more disproportionately impactful on our trade balance, right?
Yeah. So I think the first kind of trend I want to highlight is that it's a very common misconception that a lot of students walk into this course, and hopefully they don't walk out of this course with as well, which is the importance of agricultural exports and in fact agricultural production and employment to the Australian economy. A lot of people seem to think, oh yeah, we do our beef, we do our wool, and like they think it's a huge component. I don't know where it necessarily comes from. Maybe it's from a lot of media coverage that goes into the agricultural industry, but realistically these days it's almost just hovering about 10% of our exports. In its heyday, it was over 60%, and that's back in the 50s, in the 60s. But it's dramatically decreased, and it's almost as if in sync with the agriculture production and exporting falling, the resources and the mining has shot up.
That's right, and so it's almost like, in 2021, it's almost at 70%. It's not quite, right? And so the reason that's important is that therefore changes in the prices that we can receive of commodities, right, in terms of the export price, has significant disproportionate impact, therefore, on our trade balance because, depending, but certainly upwards of 60% of our exports are now commodities in terms of resources. So I think that's just one important factor that we should layer on here in understanding, okay, this is another reason why. And this obviously isn't something that's just happened over a couple of years. Like it's been really a trend. And particularly, I would say, since, the early 2000s, we've seen it go from, sitting at maybe 35% to almost doubling, right? So the last 20 years, we've sort of really seen that occur. But I think that also plays a huge role in just meaning that Australia's trade balance is particularly sensitive to, right, changes in, the global market and the global prices for commodities. So,
can I just quickly point something out about that? So I love that you mentioned that it's really kind of doubled since the early 2000s, and I'm sure there's probably some viewers thinking, well, was that some masterful plan behind the scenes that we'd engineered with the next 20 years looking forward to go, hey, there's going to be dramatic increases and demand for commodities. Let's get on that now. I think the simple
I wish we did that.
The simple answer is no, that a lot of these things are, that there's a mixture between, you've got both the private sector and the public sector. You've got policy, you've got investment, and these are all just, I think what you'll find with a lot of economics is that if you look back, and you can always tell quite a consistent story, but if you were to go back in time and navigate through those years, it's really just the summation of some pretty random set of events. Now, I'm thinking the one big event that I'm thinking of is obviously, that kind of global demand for commodities that really just dramatically shot up as a lot of countries, and I know we'll talk about China as being one of them, but you've also got India, you've got all other parts of Asia as well, just these big economies that have started to industrialize, and that's kind of what's driven that demand for those commodities.
Yeah, that's right. And so I guess it's this idea that, we've sort of been lucky to be in front of the demand with the right product to service it. It's really been a case of right place, right time in many respects, and geographically also in the same sort of sphere, really, as well. So yeah, we've been very lucky, which is respects.
I don't want to be too poetic, but that's why they call us the lucky country.
True.
But I just want to highlight that though. You've got to recognize that in economics, and you're writing your responses in your essays, don't discount the fact that things were luck. And sometimes, it's just a wonderful combination of things. I think that's kind of the theme of this video. It's just this current account surplus has just been this wonderful combination of seemingly unrelated circumstances that have just kind of fit in quite nicely like a puzzle.
That's right.
It's our job to kind of tell you what those puzzle pieces are.
Yeah, that's it. Now, the second thing I want to highlight just in terms of reflecting, and you've touched upon this perfectly actually, Terry, is that what we're seeing in terms of this trade sort of surplus we've experienced, again, has been, the seeds of it were sown by the changing direction of trade that we've also had, right?
So, more luck.
Yeah.
It's just luck.
And that's where, if we look at it, the 1960s, right, our export trade was pretty, was becoming more oriented towards Asian economies experiencing rapid growth. So Japan, South Korea, China. But if you go historically back, it was the UK, it was the Euro, it was the US, right? And they made up the absolute bulk of our trading partners. And you can sort of see through each of the decades, right, this sort of slow erosion. And to give you a sense, right, we used to, in the 1900s, so yes, that's a fair while ago, right? But let's just, for a moment, like almost 50% of our trade was with the UK. Right, you look at it 2020s, it's like 4%. In terms of like our exports at least, right? So it's a fraction. Whereas if you look at China, it's gone from like 1% to 35%, and so you can just see that again as well. The changing direction of trade has also played a key role because of the demand that these emerging economies were having, and that's also been something that we've been lucky to sort of really take advantage of. So I think we should pause for a moment because, we've looked at, the changing direction, we've looked at the changing composition in terms of how these longer term trends have shaped what's been happening in 2016 onwards, right, with our current account. Certainly 2019 onwards, but how it's, the beginnings of it come from the end of 2016 with our trade balance. I think two things we probably should dive a little bit more in and take a quick look at in explaining this is the role that the dollars played in all of this as well. And then, alongside that, what that's meant for terms of trade, because we've sort of talked a little bit about it, but I think it's an area that I think students struggle to wrap their heads around. So what was happening with the dollar from, 2016 onwards that has influenced terms of trade and contributed to the trade balance?
Yeah, so I think the first thing we want to highlight is that it actually started to recover a little bit after it had started to fall, but it recovered a little bit and that's reflective of, if you go back to your exchange rate theory, that if you end up with a lot of demand for your exports, that will generally requires an increased demand for the Australian dollar. And so it started to kind of creep up a little bit, but as you and I both know, that if it gets a little bit too high, that could actually start to impact the level of international competitiveness of our exports. And just miraculously, as things have happened, it started to actually kind of dip back down again.
Yeah.
And so that kind of retained that level of competitiveness of the exports, which was really, really instrumental in supporting that current account, that process of getting into the current account surplus in 2019.
And look, so what we've seen then, just to really highlight, is that the way the dollar contributed to this is that it supported ongoing high terms of trade, which meant that exports were attractive, but imports were not attractive at the same time because they were costing us more, essentially. And so that was supporting us convert a trade balance, to be positive. Now, alongside this, I think there's two other things that play a bit of a role here that also were things that helped push our trade balance into the positive, right? One, what was happening with the Australian dollar to cause that little bit of downward pressure? And so one of the things that was happening was, you look at it certainly when you get into sort of, topic 4, monetary policy really, is that you look at interest rate differentials. And during that period, there was a bit of a negative interest rate differential. Australia had very low interest rates. And they were, not significantly higher, but they were a little higher, particularly in the US and overseas. And that, I think, just helped place a bit of downward pressure on that dollar, despite what was going on with the demand for commodities. Alongside that as well, and these are like cyclical things that are going on, we also saw that, another huge supplier of commodities is the Brazilian economy. There were a number of major tailing dam disasters that occurred, across the Brazilian economy, which also impacted their ability to supply. And a good example of this is, this was during, 2016, was the beginning of, the US-China trade war. Australia sort of got dragged into it. And, it meant that, there was, Chinese, reluctance to purchase, lobsters and wine. But what didn't change was their appetite for our commodities because as well, they were needing it in terms of, domestic demand in the Chinese economy, but also because there was less available global supply at the time. So it really is this perfect storm when you look at it, right? It's like these long-term trends for Australia in composition and direction of trade. It's like this fortune in terms of the value of the dollar supporting terms of trade. It's this fortune, that we've got, global demand growing, but due to as well like shortened supply, everything comes together.
Yeah, I want to just quickly give it a little stat because I just love this one, because if you go around that 2019 pushing into 2020, because I love that you mentioned the Brazil dam incidents. Not that they were
not that they were good.
Not that they were good incidents. But Brazil was actually, I believe, number 2 in terms of iron ore production. behind us. And so when that supply was constricted, the price of iron ore actually tripled at one point.
Yeah.
And so it actually went from about $80 a ton to $250 a ton at some point, and it hasn't reached that far yet since then. So that was its peak. And so that just kind of just further gives you evidence of just how dramatic some of these short-term fluctuations can be. Now, the way I like to use, Rowan and I both like football, soccer, and the way I'd love to kind of put that into a football analogy is that the long-term trends that you discussed, the direction of trade, the composition of exports, that's kind of like the assist. And then all these little cyclical, short-term global factors that kind of came in, that would be like scoring the goal.
Yeah, definitely, because you're right. Without those short-term final little factors coming together,
you don't score a goal.
Yeah, the long-term factors, maybe setting it up for the trade balance to improve, but certainly not to become so significantly positive, right? So yes, love that analogy. Now, no, we've spent a lot of time talking about the trade balance. I think it is important to note that there were also some changes that were occurring on the net income deficit as well on the current account. So it's not just been a factor of the trade balance. It has been something that was impacting the entirety of the account to move it. Now, just as a quick sort of definitional thing to make sure that we're all on the same page as well, right, the net income deficit, that captures Australian residents' income from overseas, less any payments made by Australian residents to the rest of the world, okay? So in essence, this is usually the structural component of our current account because, these payments that we are receiving and making are payments that are accrued over many, many years of loans and borrowings that Australians have conducted, which is represented in our net foreign liabilities. So if we've got a significant amount of net foreign liabilities, we are, then needing to service that debt. And that's been the case because remember, we were a net capital importer pretty much for most of Australia's history. So we've been importing lots of money to fund investment. So we've needed to then actually, pay that back, whether or not it's servicing it, paying it back through dividends, and that's where it goes, right? It goes out on the net income account, and it's typically a deficit. And this has historically been really a very significant deficit. Usually it's about negative 3% of GDP, like structurally, okay? Now, usually, right? Is that?
Yeah. First of all, I was going to throw that stat.
Oh, cool, great.
Yeah, I was going to say 3 to 4%.
Yeah.
But you know what? I'm just reading my mind today. The one thing I just want to also add in is, and I love the way you summarize that as we're net importers of capital. Another term you might be familiar with in the course is a saving investment gap. And I also just kind of want to marry what you've just said, Rowan, as well with what we talked about earlier with the mining investment phase. And because what you need to be able to see the connection is that when foreigners are investing into mining companies in Australia, and you mentioned dividends, is that they actually, because they've provided their funds to be invested and they're shareholders, they actually, when those companies start to profit, which is exactly what happened, as we moved into that production phase, as they profit, they actually get a small share of that profit because they're part owners, right? So if you're an owner of something, you deserve to get a profit. They get a dividend from that because they are shareholders, and that actually flows directly out of the net primary income account.
Yep.
And so that's why, if you guys have always, that's giving you a bit of quick summary here, but if you've wondered why a CAFA surplus generates a current account deficit, that's actually one of the reasons why.
Yeah, because CAFA surpluses also contribute to that pool of net foreign liabilities, which then needs to be serviced. Yeah. Exactly. So I think one of the other things we should be mindful of here is, another cyclical sort of influence that has helped tighten and narrow this deficit because, structurally we're not going to be able to do a lot here, certainly over the short term. Now, and that was interest rates falling globally. And it started, again, mid-2016, we started entering a secular stagnation phase globally. Advanced economies' growth is slowing, so the overall monetary policy setting was increasingly lower interest rates. And then that was accelerated during the pandemic. And so as a result, interest rates decline, which means that what we needed to pay to service our debt declined. Now, of course, the interest we get paid for Australian investments overseas also decreased, but because we broadly owe more than we have lent, right? It meant that the net effect of interest rates decreasing reduced the net primary income deficit. Not significantly, but certainly it supported it, okay? Which is also helpful in shifting the overall current account outcome to be a bigger and more significant surplus. So is there anything you wanted to add there?
Yeah, so just one thing I just wanted to quickly point out, because I feel like it's obvious but we didn't touch on, is that in terms of the current account deficit, in case for those who haven't figured it out, it's made up of the balance of trade, and then you've also got the net income. The net income account. So
you've got primary and secondary, but particularly primary.
We pretty much most of the time we only focus on primary because the secondary is quite small.
Yeah, it's quite a technical account. That's exactly right.
So that's why we're making this, having this conversation, because we're saying that the balance of trade was quite good, and the main narrative I like to think of with the net primary income is that it just needs to be less bad. So being less bad is the good.
Yeah, that's right. Yeah, because it's structurally there, it's not going to shift, right?
I'm pretty sure in this whole entire period, it never actually crossed over into being in a surplus. I think at its best, we were getting into the 0 to 1% of GDP deficits, but we never were able to actually take it into a surplus. So
that's right. But that's where, when you think about it, what you really need is you need the trade balance to be so much larger to offset the net primary income deficit, which is just a constant drag on the current account. Even if it's improved, it's still negative 1 or 2%, right? So you need the trade balance, therefore, to offset it.
I love, that's a very technical word. So the way I'll be honest with you, I'm going to confess something. The way I like to always think of it is I just think of big bogs, small NPY, and that works for me.
Well, that's probably easier to remember at the end of the day, right? That's probably what matters, right? Remembering it. Now, look, we've spent a fair bit of time talking about, the current account. Now, but we did start this conversation today about appreciating that it's in a relationship with the capital financial account. And actually, the reason we've had this, current account deficit has been because of, the fact that we have the savings investment gap. We're a capital importer on our financial account, and that over time has created a net primary income account deficit, which is why we've historically ended up therefore having a current account deficit. Now, note, there have therefore been changes, because we do have, again, to come back to it, I know it's simplistic, but it's important to highlight that, your current account plus your CAFA plus net errors and emissions, right, should equal 0. Okay. Did I get that right?
No, you're right, but it's just not right. That's the thing.
Yeah, I said should, right? Operative. Operative term, should. But I think at a big picture level, what I'm trying to highlight here is that clearly then, while we've had a current account surplus, things have changed on the financial account. Yeah. Okay, and I think that's what we need to pay attention to. If they don't always perfectly equal that magic 0, and
they never do.
They don't. But it does highlight the broad relationship, and think of it almost like scales, right? When one's up, well, the other's got to offset it and balance it out. I think that's the way we should be thinking about it, even if they don't, you're never going to get them to line up to the exact number, which I know Terry's tried. So what's been happening with the financial account alongside this?
Yeah, so as you said, Ron, so if you imagine the current account has been moving kind of in that kind of surplus direction, it's important to realise that the CAFA is not necessarily in a deficit position. It's just moving closer in that direction. So rather than having the grotesquely large surplus that we probably used to have, we're having slightly smaller surpluses. Now it's moving in the right direction because as we've established, we used to historically be a net importer of capital, but since 2019 we've actually flipped the switch, flipped the script on that, and we've actually became a net
capital exporter.
I was just thinking the net exporter of capital. So
sounds so weird to say it, right?
I was like, I just had to check myself for a second.
Yeah. Now look, I think it's important to understand why, right? Because it's is it just because we've got a trade balance that's positive, right? No, there's some other stuff that's going on. What's some of the other things that are driving this?
So the first one that I want to highlight is, first of all, that as we established with when we're talking about the mining investment boom, that's why we separate it into 2 phases, because you don't anyone who's been in a business will know that you don't invest all the time. You're going to do a lot more investing in the initial kind of phases, but once your investment's in, you start generating a return on that. You can obviously go back and still continue to do some investment, but you don't need to do as much as you were to start things off, right? Because you're in your initial phase, you're buying everything for the first time. Once you've bought it, you don't need to keep buying it. So the first main kind of trend I would want to highlight is the fact that the investment has really kind of dried up since. And so there's been a significant decline in investment flowing into Australia, particularly in the mining industry. And so therefore, because as we talked about earlier, mining is such a huge component of just everything that goes on in Australia, that if the investment dries up there, it's actually going to be quite a big detractor from the overall levels.
And so now we're sort of at similar levels to other advanced economies, right? In terms of, like mining investment, right? Where prior to that, it was, significantly greater simply because of the opportunity and the demand that we're starting to flow through.
Have we got any numbers on that?
I don't, unfortunately. Oh no, we do.
Yeah.
I mean, look, broadly we do. Like
Yeah.
it's again, like the RBA. You got to love the RBA's chart packs. As in, they give you great data that you can't actually put specific numbers to very easily. It does my head in. Anyway.
If anyone from the RBA is watching, can you just
Please, right? You do so much amazing work. We love what you do.
We love you, seriously.
This is one thing that would make everyone's life easier. So look, broadly speaking, right, you can sort of see that like mining investment as a percentage of like total private investment, right, in terms of nominal GDP, it almost hits, it's probably about 9% total, right? And that's literally 2012, 2013, right? The peak of that, that investment phase of the mining boom. Now, where is it settled down to? Probably about 2%, right?
Yeah.
Maybe a little bit more. So you can see that there's just a significant shift in normalization there. That's one of the factors. We don't need to import as much capital. I think secondly, related to this, right, is that mining companies are now reinvesting as well, like less of their earnings, right? So they're making, we're in the production phase. They're making money now from digging up the earth and selling it, right? And so as export revenues have increased, right, instead of reinvesting it, okay, they're basically paying it out. Okay.
Really? They're not paying taxes for the damage they do to the environment?
Yeah, well, that's a whole other video, I think, when we get to environmental sustainability. So I think that change, right, okay, has also meant that, it's actually, and this is sort of maybe a little bit counter to what we just said before, but as they reinvest less and they pay out more dividends, what that does is it actually just moves it from, the financial account to an outflow on the primary income account on the current account, right? And so that actually makes that get a little bit worse, but then as we know, that's been offset by global interest rates.
And I love that we bring this up because the whole point of the whole balance payments is that yes, you're going to have some things that are going to make something grow, you're going to have something that take away from something. So like, for example, if we're talking about overall we have a current account surplus, but yes, there is not everything is going to move towards that current account surplus. There are still going to be things that probably move us closer to a deficit, but it's just about when you look at the overall picture. And that's why we're trying to paint a more comprehensive picture for you, because you can't just, honestly, the worst way to approach this video is if you only take one thing from each, balance payments category, because that won't be enough. It won't give you the full picture, because that's not how a balance payment works. It's about looking at all the things that go in and saying, well, overall, it's going to move in this direction.
Yeah. And I think that's what makes it complex, right?
Yeah.
Because you're so used to in economics, ceteris paribus, right? Like, all things remain equal, just looking at things in isolation. And sure, you can do that to an extent here to understand each of the individual components, but I think the students that really excel in this part of the course are those that are taking that bigger picture view and understanding the interconnections between the accounts and the relationships, right? Now, the final thing, Terry, that's also been shifting us to become a net capital exporter is superannuation.
Yeah.
Tell me more. That's interesting.
The first thing I want to tell you is that I've officially lost track of how much of my pay goes into superannuation. Because it started off, I remember when I was in school, it started off at 9%. Yeah. Then I started working and it got up to 10, 10.5, and then it got to 11. Now, is it 12?
Yeah, I've lost track as well.
That's concerning, right?
Yeah, I know. I mean, there are people in Art Smart that know this.
Okay.
Do I know this right now?
Does the CEO know how much?
But I think the point is exactly every year it's been going up by about 0.5%.
Yeah.
Right?
And I think, so not only is there more money being funneled into superannuation accounts, there's also what they've decided to do with that money. So a quick little overview for those of you who aren't too familiar with superannuation, because if you're a high school student, you might not be getting super at the moment. Super is your retirement account, and it's managed for you by a superannuation company. And because it's managed for you, they will basically take those funds and invest it on your behalf. Now, where they choose to invest that is totally up to them. Now, you can self-manage. We're probably not. We're not financial advisors. We're not going to touch on that. But most people, I imagine, just leave it with their super.
You put it in an industry super fund,
and
low fees, and they manage it for you, right? So they're making decisions.
Yeah. It just sounded like we're trying to get sponsorship from like a
sponsor us, like any of this super fun going around.
Yeah.
Like we're here. But I think the thing to highlight as well is that it's compulsory, right? Yeah. So companies will need to pay it, on top, and it's not in addition to your earnings. So in other words, it's basically forced national savings. It's like a neat way to think about this, right? Because at the end of the day, we talked about like the reason we were a net capital importer as well was because our demand for investment outstripped our national savings pool, right? So if you're forcibly making Australians save money for retirement, and that number is increasing every year by 0.5%, right? Or at least certainly for the last couple of years, you're basically increasing the pool of available national savings.
And you're decreasing the saving investment gap.
That's right, exactly. And then if at the same time the demand for investment has dropped because mining investment is no longer as high as it needs to be, you start to see that equation starts to rebalance, right? And then you throw on top of that COVID, which also saw increased saving because, you just couldn't go and spend stuff, you couldn't go out, couldn't travel, right? All of that also further adds, I think, to a growing national savings pool.
Yeah. Right? Yeah, and I think what we then take is that we not only do we have more savings, but where we're choosing to go those savings has changed as well. Yeah. So I think I've actually noticed this as well with my superannuation, that these companies, they've started to allocate a much larger proportion of that fund into foreign equities. Now that's just a fancy way of saying they will buy more shares from overseas. They'll hold it for you, and then they'll pay you. They'll generate a return. They'll give you a return. Now I've actually been quite curious about this because I've speculated a few things, but I'm actually curious to know why they've done that. Is it because there's been a changing in kind of sentiment and increasing level of financial literacy amongst Australians themselves? Is there a desire? I was just curious about why they've had that desire to actually go out and invest more in foreign equities.
I think in part, I wonder, this is again, I guess I'm spitballing on this a little bit right now. My sense is that I think it's become easier as well to access foreign markets, right? Yeah. Whether or not that's, through an exchange traded fund, right? Where, you're getting an index of a market more broadly in terms of emerging markets, whatever it might be. And so I suspect that that's maybe just been part of a trend. It's become easier. There's more financial products that enable that to happen. But I also think part of it as well is, I think it's also about chasing returns. At the end of the day, emerging markets often, are going to have higher levels of economic growth, also greater levels of risk and volatility, right? But they're certainly going to have high levels of growth potential. And so I wonder if it's also just a reflection in, trying to drive returns.
Yeah, because I think superannuation companies, at the end of the day, there's multiple of them, and they are in a very competitive market. And if they aren't generating profitable returns, a lot of people are going to be.
And I think particularly, I think the other factor I suspect, and this is about looking at again the Australian economy and some factors that were driving this, is that interest rates were incredibly low, right? They've been incredibly low in Australia for a long period of time. So as a result, a lot of the time, superannuation, they're going to look at fixed asset, fixed income sort of income streams. They're going to look at bonds. They're going to look at these investments that are largely also quite safe, that are going to provide regular, consistent income. And when you've got a very low interest rate environment for a very long period of time, I think you're forced to have to look elsewhere to try to generate returns. So I suspect that's why.
I think we just uncovered some crazy truth.
Yeah. So let's just, I think now, it's been a long video. We appreciate you hanging along all the way, right, with us, if you're still watching at this point. And those you are, Ben 6, here you come.
Super.
Right? But I think if we sort of zoom out, right, what we can see, and I think this is about, and we're going to touch upon this in our next video, right? So I want to highlight, we've sort of given you a really good, I think, deep dive on what were the trends that were leading to us becoming and having consistent current account surpluses. And if we zoom out, we looked at the current account, we looked at BOGs, we looked at the shift in the trade, the balance of trade, composition, direction. They are long term as well as shorter term, sort of like scoring the goal, to use the analogy. And then we've also looked at what's been going on with our net, capital importing versus exporting and changes on a financial account. Now, I think the thing to think about here, though, is what will the future bring, right? Given that we have been historically a deficit, we've just talked about that in some respects, a lot of where we've been over the last sort of, 4 years or so has been crazy, lucky, cyclical benefits, some things going on that, we couldn't have necessarily predicted. And I think the question is, well, are we going to be heading back towards a deficit, right? At what point do we sort of see our good luck run out, right? And so I almost want to like leave it there. I mean, Terry, you might have some final wrapping thoughts, because if you're curious about that, then stay tuned for our next video where we're going to be looking at, okay, what are the current trends? Like, a lot of this has been all building up to what is the position of our current account today? What is the position of our financial account today? What's the balance of payments look like today? And what will it look like as we start to project into 2024 and beyond? So if you haven't subscribed, so you get notified for that video. But Terry, any final wrapping up?
Yeah, I just wanted to finish up my football analogy. And I think as we've established that the surplus in the balance of trade has been the assist, and then let me rephrase. If we look at the cyclical stuff as the actual goal itself, but the long-term structural kind of factors as the assist, I also want to kind of paint the same picture with the CAFA, and that in soccer, it's not just about scoring goals, it's also about preventing them. And so the fact that we've had, a bit of a improved performance in the CAFA has also kind of been, let's just say, it's like your defense playing really, really well.
Yeah, I really like that. It's a great analogy. I love it. So there you go, right? You can quote your teacher soccer analogies to help explain why we have a current account surplus. But look, if you have any questions, let us know in the comments. We get that this is a super challenging topic to wrap your head around. There's so many interconnections. It can be really challenging. It's probably the most challenging topic in the HSC Economics course. So if you do need additional help, like hopefully this video has helped, but if you're like, I'm still needing help, don't be shy, get in touch with the Art of Smart team. We've got an incredible team of teachers and tutors that can support you navigate balance of payments and the economics course itself to really help you score that, whether or not it's a band 6 or band 5, but significantly improve your results in the course. So check the link below, but otherwise we will see you in the next video.